Unfortunately, what's good for some is bad for others. This is Tyson Ray, financial advisor at Form Wealth Advisors, where we exist to help make life better for our clients and those in our community. The market for July finished up, in part because the Fed raised rates again. My thoughts on the Fed are this: the Fed and the economy are in a battle, and I'm believing over time the Fed is going to win and accomplish what they want to accomplish, which concerns me with regards to the markets, that I hope they get it over with sooner than later, because the higher this market goes and the more the Fed continues to keep rates high, the more likely the market can correct again before we go back to the all-time high in January of 2022. What I'm excited about is that this market is now 18 months long in its downturn. So it was January of 2022, a little over 18 months ago, that the market reached its all-time highs, and we're not back there yet. And for some of you, you might be wondering, why would that be a good thing? Well, that's a good thing for all of our clients that are accumulating, for all of investors that are adding monthly to 401ks and taking advantage of dollar cost averaging. This is giving them an opportunity to take money and buy into a market below where they could have done it in January of 2022. And so that's a good thing, because basically the market is still on sale, though it's coming back. The bad thing is, for those clients that are in retirement and now need to live off of the profits or the excess returns of their portfolios, I want to remind you that we haven't had a positive excess return going back to January of 2022. And I've said reoccurring theme in these up or downs is that if you were living off of a 4 or 5% distribution from your portfolio and you didn't make that in 2022 and you haven't made it in 2023, as far as judging from January 1st of 2022, as we take money out, we're taking it out of previous returns, or in some cases, principal. And we've been imploring you to consider tightening your belt, because the longer it takes for this market to reach a positive return going back to January of 2022, the more you will take out of your principal. And for some, you may regret that, though it may take a decade or two when you look back on it. So, what I want every client to be thinking about as we're coming out of July and coming into the second half of 2023 is, what do you need between now and the end of the year that's changed and you need to let us know about? And more importantly, what are our plans for 2024? And what are the resources we're going to need to enjoy the life that you have? For some, it may mean tightening your belt. For others, it may mean realizing, hey, this market being down is still a good thing for you. Either way, if your advisor is talking too much to you about your portfolio or about interest rates or about the Fed and not enough about how you need to be managing your money, why don't you come have a conversation with us? And for all of our clients, please know that we are doing the best we can to set aside resources and allocations to meet the goals that you have, and encouraging you at the same time to participate with us, because if you need to tighten your belt, only you can do that. This past Thursday, we just wrapped up our Forming Perspectives webinar, where we go into a deeper dive of our thoughts. For those of you that missed it, we're going to be sending out a link in the next couple of days if you want to be watching out for that. The purpose of these up or down videos is to try and bring a little understanding about what you should be doing with your long-term investments based on what is going on. And so this is Tyson Ray, financial advisor at Form Wealth Advisors, where we exist to help make life better for our clients and those in our community.